Hello, welcome. Today we're going to go over the wheel strategy. This is my second due diligence report. It's a little bit different. This due diligence, or DD for short, is a deep dive in how to trade the wheel, which is an option trading strategy. But I'm also going to give you a couple of recommendations of tangible good stocks that are probably worth trading the wheel strategy on as well. How I'm going to do this, because the thing is the world of options can get quite complicated very, very fast. But I'm only going to teach you what you need to know, and I'm going to teach it in a way that if you're straight off the street, if you don't really know what an option is, you should be able to start doing this trading strategy by the end of this video. Well, by the end of the video, you're going to have a summary, but then if you go and read my full report, by the end of reading that, I hope that you kind of have a rough idea of how the wheel works, how it makes money, what's the risks involved, and all that. And you might learn a thing or two about option trading as well, which is cool. So first of all, this is my website where I post my due diligence reports. I have two. I have one on LEU, which is a single stock, which I've done. That one's going really well. And I've just added in my second one, which is on today's video. So I'll drop this in the comment section or the bio or whatever. Click on it. Sorry, just recovering from a flu. It's terrible. Click on it. It'll take you to my website. And if we go on DD up here, or you can click down here, but if you go on due diligence, actually I'll just leave the link straight to the due diligence page. And you can see the two reports I've done now. The first one being on LEU. If you haven't seen it, I've got a full video breaking down this. That's doing really well. I posted this report on the 4th of September. September just gone. So far the stock's ripping up and we're at a 78% return after releasing this report. So that's going well. And the second one I've just posted is a due diligence report on the wheel option trading strategy. So yeah, jump on, have a look. Donate link if you like my work. If you make some money or whatever, don't have to, but you can feel free to donate. And down here I've got the stock I'm picking, which is not the stock I recommend you picking, and I'll get into that in the report, is wheeling Snapchat. The reason why Snap isn't a good idea is the stock is a shambles. Snap have never been profitable. Actually, I think 2021 they had one single profitable quarter, but basically never turned a profit. They've been bleeding money. But I'll get into why I'm wheeling Snapchat. But and also why I don't recommend you do this. I'm not going to tell you what to trade. Do it if you want, but I'll break it down. But I chose wheeling Snapchat because I'm not going to have to risk that much capital, because the Snap share price isn't that expensive. It has the option volume to do the wheel. And I believe it's going to have plenty of ups and downs. We've got an earnings coming up where it's really going to show a true pros and cons, the highs and lows of doing the wheel strategy. So it's more of an educational reason for me picking Snap. Anyway, we'll break that down as well. The ones I recommend, you'll see them come up. Okay, so clicking into this, and here's the full due diligence report on the wheel strategy. I'm not going to go over every detail in the report. I think it's about an 8,000 word essay. It breaks down step by step, chronologically and systematically, how to trade the wheel. So you just read through it, all right? If you want to learn a thing or two about options, you want to learn why the wheel strategy works and how to do it, and how to set it up so it can work for you, right? And how to reduce risk. Have a full read through. But today, we're not going to go through in great detail. We're just going to do a summary. I'll try to, if you don't know what a wheel is, or if you know what the wheel is, but maybe you want to deepen your understanding, watch along. And we'll just go through it, and I'll just summarize basically what we're trying to do. Because at the moment, if you have no idea what I'm talking about, you're probably still lost. And that's fine. We'll get into it. Okay, so this due diligence report is going to be a little different. Because in this one, normally I'll conduct deep research in a singular stock. Like my LEU due diligence, this is kind of different because most of this due diligence is teaching how to trade the wheel trading strategy, all right, which is an option strategy. It involves a cash secure put mixed with a covered call. Don't worry, I'm going to break down each one. So most of it is that. And then towards the end, I'm going to get into some viable wheel underlying stock candidates, because you can't just go wheeling anything, and there's a specific reason as to why that wouldn't work. So it's more of a stock recommendation of a handful of stocks that you can trade the wheel strategy on, instead of one specific stock like the normal due diligence. But I do hope after the options section of this report, you probably don't need my stock recommendations on what to wheel, because you'll see why. Because the stocks that you should be wheeling are pretty simple. They basically meet two criteria. Well, we can say three. Usually it's stocks that you already want to own anyway, but you've got to make sure that those stocks also have optionality, meaning you can trade options on them, and option volume. They must have really strong option volume or liquidity. If they meet those three, and if you can afford a minimum of 100 shares of that underlying ticker, go ahead and wheel it. A few more caveats to that, but that's essentially it. Okay, with that being said, let's just break down, and we'll start from scratch, and we'll go over and we'll learn what the wheel strategy is, how to set it up, what to do, what delta, what DTE, and all that kind of stuff, what implied volatility. Let's break it all down. Okay, so that's a quick introduction. So basically options, if you don't know what options are, technically they give you the right but not the obligation to buy the underlying asset at an agreed upon strike price at an agreed upon future date. And again, if you even that itself doesn't summarize it, but I've got a really good example down here of what an option is. So basically in this report, you don't need to be an option wizard to trade the wheel. In fact, while I'm writing this as if the person reading it has zero option trading experience. The options are quite advanced because they usually price on something called the Black-Scholes-Merton model, which is basically a bunch of financial scientists that got together in, I think, the 80s, and they derived a formula, and the formula is a partial differential equation. And if you're not that much into mathematics, to show you how advanced a partial differential equation, or a PDE, is, you would probably learn PDEs in perhaps the second year of a university mathematics, maybe statistics, engineering, physics degree. That's probably when you're going to start to learn PDEs, because before that you got to go through Calc 1, Calc 2, probably Calc 3, and inside those calculus modules you get into differential equations. I think differential equations is in between Calc 2 and Calc 3. Or it's like sometimes a side branch from that, but it's about the Calc 2, Calc 3 level. And when you first do differential equations, you do ODEs, which is ordinary differential equations. They gradually get more and more advanced, and then PDEs, partial differential equations, usually in or after Calc 3. So there can be, what I'm getting to is it's quite advanced, but do you need to know that to trade options? No, you don't. That formula is just basically for the market maker to figure out what price they need to charge you for that option. I guess we're going to get into what an option is straight away. Apologize about the coughing. So that's what the Black-Scholes-Merton model basically is. Now, they don't use precisely the Black-Scholes-Merton model these days, but they do use a variation of it. And when you're thinking about pricing options, you're better off thinking in terms of BSM, because it's usually some type of variation of that. Okay, so that's the technically how they use a pricing option, but that's not what you need to know. It's just like a fun thing to know. What you really need to know in a street way about options and how they're priced is you need to understand the time value component of an option, which is called theta, and basically the implied volatility, which we just shortened by saying IV. Because the more time there is, I don't want to jump too far ahead, so let's just wait. We'll get into that. The structure of this due diligence, yeah. And this is a summary of the wheel strategy. Basically, you sell puts, you collect premiums. if you get assigned, you then get assigned 100 shares of the underlying asset, and once you get assigned those shares, you start selling a call contract against those shares, and then once those shares get assigned, you'll get what's called called away. So the 100 shares that you received from getting assigned from selling the short put, eventually they will get called away after your short call position finishes in the money. That's not going to make any sense if you don't know what options are. And then once you get called away, you go straight back into selling puts. So basically, let me give you a step-by-step play. It's fine this morning, now I start coughing. Okay, step 1, sell a put contract. You're agreeing to buy 100 shares of the underlying stock at a certain stock price if the option is exercised. Step 2, get assigned. If the stock closes below your strike price at expiration, you'll be assigned 100 shares. Step 3, sell a call contract against those shares. Now that you own the shares, you sell a covered call to generate premium income. By the way, step 1 is also generating premium income as well. Step 4, your shares get called away. If the stock price rises above the strike price, your shares will be sold at that strike price. Step 5 is repeat the cycle, return to step 1, go back to selling puts, continue the endless wheel. Okay, now we're going to get into some option learning, and we're going to learn a little bit about it, all right? Above here was just giving a broad summary. It's more for people that at least know what an option is. They can kind of read the summary and start, oh yeah, that kind of makes sense. But if you don't, you might be best just to skim over the first part of this report and skip down to learning about options. And by the way, I'm only teaching you the pieces that are relevant to doing this wheel strategy, all right? Okay, the textbook definition of an option is a contract that gives the buyer the right, but not the obligation, to buy, brackets a call, or to sell, brackets a put option, an underlying asset at a specified price, which is called the strike price, within a specified time period. Okay, if that still doesn't make sense, the street definition is in a way this. This is quite broad, but in a way this. Say stock, ticker ABC, is trading at a $100 share price. Mike thinks that in 2 weeks, stock ABC will trade above 120. So he thinks the share price is going to go up by more than $20. Sarah disagrees. Sarah says to Mike, if you pay me $10, which is premium, I'll give you the right to buy 100 shares from me at $120 each, $120 per share. But only if the stock finishes above $120. See, the $120 there is what we call the strike price. If it doesn't, I will keep your $10. Mike thinks about it. Normally to buy 100 shares of ABC, he has to put down $10,000 because 100 shares times $100 share price is $10,000. But with this option trade, he only has to risk $10 instead of $10K. Because remember, if you own the underlying stock, what's at risk is your total position size. Now, I know most stocks aren't going to go to zero, but when we're dealing with options, we want to simplify things. Like we know probably Apple stock won't go to zero, all right, for obvious reasons. But when we are trading options, we need to think of absolute risk. And the absolute risk of holding stock, whether you like it or not, whether it's blue chip or not, is that company goes bankrupt and the share price goes to zero. So to simplify, and I know that that's not kind of what's at risk, but to simplify, we just say what's at risk is the total position size. So yeah, to buy 100 shares of ABC, you'd have to put down $10,000. 100 times 100 is 10,000. And that is something else we'll get into. It's just because one option contract holds 100 shares worth of stock. But this option trade, he risks $10 instead of 10K, while still getting the potential upside if the stock rips past 120, because one option contract holds 100 shares. Now the reason why that is because, like I said, one option contract holds 100 shares. If it passes the agreed upon strike price, it's as if you have 100 shares of the underlying and you're making the same returns as if you held 100 shares of the underlying. Meaning if it passes 120, you can basically say the trade's on, I'm now making money. And if it goes up past 120, goes to 130, 140, 150, your returns would be as if you had brought 100 shares at a $120 share price. But he only paid $10 for that contract instead of having to put down and risk $10,000. So you could see with options, you've reduced your risk all the way down to $10 from $10,000. Now that it might not be, this is a rough example. It might be that ratio is quite far off, basically. But I'm just trying to make it really obvious what an option is and why people trade them. Okay, so Mike accepts the deal. All right. So what happens? 2 weeks later, stock ABC finishes at $119.99, just a penny shy of $120, which is the agreed upon strike price. Mike loses his $10 premium. Sarah keeps the $10 profit. So the reason why Mike lost the $10 he risked was because it didn't meet the agreed upon strike price, meaning that contract expires worthless. Expires worthless for Mike. Sarah, well, she made the $10 when she first made the deal with Mike. Sarah keeps that $10 from when the deal came. She never has to give that $10 back. She keeps it. So long as that share price doesn't finish above 120, Sarah just keeps 100% of that $10 she got paid from Mike. Now, if the share price rocketed past 120, Sarah has to cover the difference between the 120 strike and whatever the strike price is above 120. So she'll be out of pocket, and she has to give that to Mike at the end of at expiration. So right there, you can sort of see why people tend to trade options. Seems a little too good to be true, right? There is a lot of caveats, and usually option buyers most of the time lose money. And that's because options are generally overpriced, but we'll get into that later. All right, some basic FAQs, frequently asked questions, and my hope is with this section is by answering some frequently asked questions, you'll understand kind of what you need to know about options before trading the wheel. All right, let's get into some frequently asked questions. Okay, what's in the contract itself? Well, each contract represents 100 shares of the underlying stock. So when you see an option price quoted on an exchange, that price is per share, and you must multiply it by 100 to get the total cost. For example, if you go to an option exchange, which we are going to do, by the way, if an option is listed at, say, 34 cents, that contract would cost you $34. What you see listed, you have to multiply by 100. So just remember that. But usually when you press buy or something like that, it'll give you a quote price, and you'll usually see like max risk or max profit, and that's basically how much you're paid or received from that contract. What is a strike price? Strike price is an agreed upon price of the underlying stock written into the option contract. In simple terms, it's the price you're betting the stock will or won't reach by the expiration date. So again, imagine a stock with a share price, current share price of $100 per share, a 120 strike. If you're buying that, it means you want the stock to go above 120. If you're selling the 120 strike, it means you do not want the stock to go above 120. Same with puts. So puts would usually be, you're usually betting on a put if you want the price to go down. So if you're going to sell or buy an 80 put, if you're going to buy an 80 put, you want the stock to finish below 80. If you're going to sell an 80 put, you want the stock to finish above 80. So it kind of inverses itself from calls. All right. What is an expiration date? Well, the expiration date is the deadline of the contract. So each contract has an expiration date. It's the date that contract expires. So for our 100-120 call example, we're going to bet that it finishes above 120 by a specified date. Okay. And date, we usually just say DTE, which is days till expiration. It means the same thing as the expiration date. Do you have to hold options until expiration? Quick answer is no, you don't, because most options you're going to be trading are US style options. Now, technically, there's European style options, which yes. Oh, sorry, I'm thinking of something else. I'm thinking of someone exercising that option on you. My bad. So exercising an option on you is, I actually should fix this sentence here. It's not technically correct. When I was writing this, I was thinking of exercising. So US options can be exercised at any moment, at any time up to expiration. Now they usually don't. Sometimes they can get triggered over dividend events. But I've traded thousands of option contracts before, in the money, out the money, at the money, different tickers, even over plenty of dividend events, and I've not once ever been exercised, short, long, whatever. But that doesn't mean that can't happen. So yeah, I kind of should fix this sentence up. Because even in European style, the reason why I wrote this is just to say basically, no, you don't have to hold options to expiration. You can trade them anywhere throughout the expiration. And you can actually do that with European style options as well. For whatever reason, I thought I was talking about the exercising of the option. But to answer this specific question is no. It's a contract, and the contract's traded as if you're trading stock, basically. Like each contract, like, you know, if you go to buy shares of Apple or whatever, you go onto the stock exchange or brokers platform, you see a bid-ask spread, and you go to buy some shares. Well, it's like that, but for each individual contract has its own little market, all right? So it's just the same as if you're bidding or trading a stock for each individual option contract. Okay, some abbreviations. What does in the money, at the money, out the money mean? In the money, the option has value if exercised. For example, a call with a strike of 90 when the stock is 120. You can buy at 90 and sell it at 120. So you've got a $10 gap between the strike and the current stock price. So that means it has $10 worth of intrinsic value. I think it's intrinsic. Yeah, intrinsic. So extrinsic is the option's value itself, like the Greek terms within that contract. But intrinsic, hopefully I'm not screwing it up, but we're about to go over that in a second, is the option's value as if you were to exercise it today. Okay, at the money is basically the strike price is about the same as the stock price. Out the money, the option has no intrinsic value. Yeah, basically. It has value if the stock moves. So you only have intrinsic value if the if the option is then in the money. And for a call example, the option is in the money if the stock's share price is greater than the strike price. Intrinsic, and extrinsic value. Intrinsic value, this is the real tangible value of the option if it was exercised right now. For a call option, intrinsic value is the stock price minus the strike price if positive. For a put option, it is the strike price minus the stock price. If the option is out the money, it has no intrinsic value. It's entirely based on potential. Very good wording there. Okay. Intrinsic, also known as time value, this is the additional value of an option because there is still time left until expiration. Because if there is still time remaining to expiration, the contract still has value because it still has some type of likelihood of finishing in the money. We're going to go over IV and all that too very soon. Okay, step 1. So the first step is to sell a put contract. That's going to get our wheel going, is selling a put contract. A put contract is an option contract that gives the buyer the right but not the obligation to sell 100 shares of a stock at a set price before the expiration date. When you sell a put, you are taking the other side of that trade, agreeing to buy 100 shares at the agreed upon strike price at expiration date. So basically, if you buy a put, it means you want the stock to go down. Why? Because if the price falls below your strike price, you have the right to sell 100 shares at the strike. You could then buy those shares back on the open market at a lower price locking in the profit. Now that's going to understand quite confusing unless you completely understand what short selling is. But don't overthink it. Just basically, if you're buying a put, you're betting that the price is going to go down. Which selling a put is the inverse. Selling a put is you're betting that the price goes up or at least stays above the strike price. So to summarize what selling a put is, without getting into this, and if you're still confused, just please read it. If you sell a put and the stock price doesn't drop below the strike price, you get to keep that premium. If you sell a put and the stock price drops further below that strike price, you are obligated, basically forced, to buy 100 shares or lots of 100, depending how many contracts you buy, at whatever that agreed upon strike price is. So going back to our $100 per share example, if you sold a put contract at an $80 share price, if the stock finishes at 90, so it drops by $10, nothing really happens. You keep 100% of whatever someone paid you for that option contract. For selling that contract, you keep all the premium, right? If it dropped to 70, then you are forced, it gets triggered at an agreed upon expiration date, and you are forced to buy 100 shares at the $80 strike price that was within that contract, if that makes sense. Now, to make a sense of this, so this leads into like delta, theta, and applied volatility. I'm only going to go over these three. We call these Greeks. Well, these two are Greeks, and implied volatility isn't a Greek. It's like I was going to say a phenomenon, but it's a thing that is baked into an options price. We'll quickly go over these three. Now, there is a lot more option Greeks that you can get into and learn. But for this strategy, we really only need to know these three. And the reasons why we'll get into. So delta, again, you don't really need to understand this, but basically delta measures how much an option price is expected to change when the stock price moves by $1. Don't overthink it too much, because that specific reason, good to know, good to learn, but that specific thing is not really what we need to know, or not, it's not really what we need to think about when we are into selling option contracts or buying. What I need you guys to understand properly is the probability that's kind of linked to delta. So delta is also used as a rough estimate of the probability that that option will finish in the money. I won't break down mathematically how that works. It's a little complicated. But basically, if you see a 30 delta, and when I say the word 30 delta, it's usually displayed as 0.3, and it could be negative, could be positive. It's negative if it's a put contract, it's positive if it's a call contract. Sorry. So keep that in mind. But 0.3, I'm meaning 30 delta. That also means that approximately it's a 30% chance of assignment. So if we are selling that contract, we're on the other side of the trade, which means it gives us a 70% chance that that option expires worthless. Meaning it gives us a 70% chance we have to keep the premium that we initially received for the sale of that option, which is what we want, by the way. So basically, I'm going to be saying from this point onwards, sell a 30 delta put option. And I'm also going to be saying sell a 30 delta call option. When delta is below 50, it's what we call an out the money contract, all right? We discussed out the money above there. And in this wheel strategy, remember the two components, cash secured put and covered calls. Right now we're talking about cash secured put only. But in both of them, both pieces of the wheel, we're selling approximately 30 delta out the money call or put contracts. So if you don't take away much from this, and if it doesn't make too much sense if you're new to options, just know and remember, if you aim for selling 30 delta contracts, you're going to be gravy. That's the main thing we want to know. And 30 delta is quite consistent, meaning that a bit of research has been done with wheeling or selling contracts, and approximately most of the research points towards you want to be selling roughly a 30 delta. Okay, And remember, selling a 30 delta gives you a 70% probability of profit, or probability that the option contract will expire worthless, which is what we want. So just remember that with the delta. Now, theta is known as theta decay or time decay. Quick plug, that's obviously my brand name, because it's one of my favorite Greek option variables. And you can read into why that is. So basically theta is the time value of that option, and it puts a value on time. So let's do a little exercise. If you buy a contract and if there's 100 days to expiration, there's a lot of time value baked in that option. So that option should be more expensive if you're going to compare that same option to, say, one that only has 20 days to expiration. The reason why a further dated option is going to be more expensive than a closer dated is simple. Well, the longer we have, the more time we have in our option contract, the more of an opportunity we have for the underlying share price to hit our strike price. The less time we have, the less probability there is for that underlying share price to hit the strike price. So that's basically what time is when you talk about options. It's how much time do we have to hit our strike price. And that time value decays exponentially. This is one of my favorite graphs when we're talking about theta decay, and this is why we decide to sell options at a 45 to 30 DTE. Because you can see the difference between 120 days to expiration and, say, 80 days to expiration. The option contract doesn't devalue that quickly, but it starts to speed up past 60 DTE, and it gets faster and faster and faster. And that's just simply because the probability of said option finishing in the money just gets smaller and smaller and smaller and smaller until it's zero. Until it's zero. And that's an interesting thing about options. Now, if you've seen this graph, now that you have seen it, and think about being on the other side of this trade. So think about being long options, buying options, not selling them. You are fighting for your life against theta. Meaning, if you're long an option, you want that option contract to increase in value as much as possible. But with every passing day, the value of that option, the time value of that option, is deteriorating exponentially faster and faster and faster. If you're an option seller, this is an excellent thing, because option sellers are short options. You make money from the options value going down. So you want time decay to be on your side. And if we want time decay to be on our side in a higher degree, well, just by looking at this chart, we want to be selling around this between 60 to 40 or 30. Now, the recommended advice is usually 45 DTE to 30 DTE. Because although this graph, and you might be thinking, well, that's still right on 60 every time, that's cool. It's usually is always baked into the option price. Because let's think about selling a 20 or selling a 40. Selling a 20, you're obviously going to receive less premium for that option, right? So less money up front. But you're going to have a quick turnover rate, because once you reach expiration, and if you do not get assigned, then you roll straight into selling another 20 DTE. So you can sell two lots of 20 DTEs in the same time frame as selling one lot of 40 DTEs. But a 40 DTE, you're going to receive more money up front, but obviously now it takes 40 days to expiration. You see what I'm kind of getting at there? It is kind of relative. So we just go for a happy medium. We usually just sit between 45 and 30 DTE. It's about a nice spot to be. But again, it may not matter too much, because like I said, think about the turnover rate of the wheel, of the selling the options. Sorry about the coughing. Bad form. Okay, so that's theta. So the conclusion with theta, I forgot to do the conclusion with delta. The conclusion with delta is to sell a 30 delta put contract. The conclusion with theta is to sell a put contract with a 30 to 45 DTE days to expiration. Okay, next thing, implied volatility is one of the most important things to understand when it comes to option trading. I cannot teach you everything you need to know about implied volatility in a few lines of text. But what you do need to know is this. Let's do the textbook definition and let's do a street definition. Okay, I feel like I came up with this street definition because I haven't heard it from someone else, but it's something that I've always taught if I'm going to teach implied volatility. So implied volatility is the market's forecast. I'm so sorry. Implied volatility is the market's forecast of the likely magnitude of future price movements in the underlying asset, expressed as an annualized percentage, is derived from an options market's price using an option pricing model such as the Black-Scholes model, and represents the volatility level that, when input into the model, yields the observed market's price of that option. If you don't understand that, forget it. It's confusing, I know. What it basically is, okay, just think of an insurance company that sells car insurance. When you buy car insurance, you pay a premium. Usually it's monthly, whereas in options it's a one-off payment. Same thing. To insure your vehicle, how does the insurance company decide how much to charge you? Well, one thing they do is they look at your driving history, right? And if your driving history is volatile, meaning you've had numerous accidents, they're going to charge you a higher premium. Because it makes sense. They're looking at your driving history. This guy's an idiot. He's all over the road. He's crashing. We'll still insure him, but we're going to charge him a lot more money. So, same kind of thing. Your driving is volatile. The previous stock price of this stock is volatile. The likelihood of this person who we're insuring, giving a car insurance policy, the likelihood of him crashing is higher because of all his crazy driving, criminal record, whatever in the past, his accidents and everything. As opposed to someone who's never had a single accident. I'm going to charge him less premium. It's less likely he's going to have another accident. But it's more likely for this guy who's had heaps of accidents in the past to have another accident. Okay? Apply that to a stock. Said stock is viciously volatile. It's swinging up and down. One day it's up 50, the next day it's down 50%, and it's all over the place. Okay, well, what's a fair value to now charge, say, a call contract or a put? It doesn't matter. Well, I'm going to charge a lot more money because of these price swings. This stock can flick up and flick down at any given moment. So I need to bake that in to this option's price. I have to, all right? Versus a stock that's very steady, barely moves. Its average daily price move is 0.1% or something like that. Yeah, it's unlikely for that stock to jump up 50% tomorrow. So I'm going to charge less for that option contract. Now that is basically what implied volatility is. There's books and books and books on implied volatility. Behind me, if you ever get into options, you probably want to do like a basic option textbook first and get a good genuine understanding. My all-time favorite book on implied volatility, I should have it here somewhere if I can see it. This baby here. From Ewan Sinclair, Volatility Trading. It is like, because I've read a few different books on volatility, but this is like my Bible when it comes to volatility trading. And shout out to Ewan Sinclair. He's a fellow Kiwi, which originally I came from New Zealand, but I live in Australia now. But yeah, fellow Kiwi, very, very good derivatives trader and a wealth of experience. But he actually has heaps of like YouTube videos. He's not big on YouTube, like you don't see him everywhere. But if you just type in Ewan Sinclair, you will learn so fucking much about option trading. It's unbelievably the amount of knowledge that he has, and cutthroat, straight to the point, no BS. Couldn't recommend him enough if you want to learn a lot about implied volatility and volatility trading itself. We'll park IV there, but just remember that's what IV is. So you're going to see something called an IV value. An IV value, right? You're going to see a number based on your brokerage platform. It could be 50%, 150%, 20% or whatever. Now that number is basically the mark in a roundabout way. It's the market's forecast on where they think the stock could go within a 1 year period. So if you see an IV of 50, for example, generally that means that market makers or just people trading options believe that within a year the stock could either be up 50% or down 50%. So when you see IV, that's kind of what it means. It's actually a bit more technical than that. When you see IV, it's actually within a 1 standard deviation move. Probably of 1 standard deviation move is about 68%, but don't worry about it too much. Just when you see it, that's kind of what it means. And I do go into IV rank as well, handy to know. But basically all I want you to take away from this video is just a higher IV generally means the option price is going to be more expensive. A lower IV means it's going to be cheaper. Okay? But do read this if you want to get into it. I definitely recommend reading the implied volatility section. Okay, so in summary, in step 1, sell an option, an out the money put contract between 30 to 45 DTE with about a 30 delta. IV you can look out for. Perhaps try and sell when IV is high, generally around earnings, but don't overthink it, stick with the plan. We'll get into the end why we want to stick to the plan and why you can kind of overlook IV to a certain degree. We'll get into that at the end when we summarize. Alright. Step 2 is get a sign. So this is very easy. So remember how I said that if you sell put contracts and the share price moves below the agreed upon strike price, and if you do nothing, you'll get assigned 100 shares or lots of 100 shares. Like if you bought 3 contracts, it would then be 300 shares. Sorry, sold 3 contracts. So you're basically waiting until you get assigned. And if you wanted to own the stock anyway, which is the most important thing here, congratulations, you now own 100 shares of a stock that you already wanted to own. Also, you now own that shares at a discounted price. Because think back to when you first sold that put contract. Think about what the share price was then. Usually, if you sell a 30 delta, it's different between each stocks, but let's say a 30 delta is 10% out the money, meaning the stock price would have to drop 10% to hit that strike. If it hits that strike and you get assigned, you have just bought a stock that you already wanted to own at a 10% discount. Sounds good, right? Keyword stock you already wanted to own. That's what assignment is. You just get assigned those shares. What happens is on expiration date, after market, usually on a Friday, you'll wake up Monday morning and you'll see 100 shares of that stock in your bank account. Congratulations, you now own some stock. Okay, so yeah, you just long 100 shares. Now immediately, some key things actually I should cover. Make sure you generally want to own the stock. Can't stress that enough. And ensure you have enough available funds in your brokerage account to purchase their assigned shares. So here's the thing. Just using one contract as an example. Each contract holds 100 shares, as I've covered before. Now, you've got to be prepared. You have to have enough cash in your brokerage account to actually buy those 100 shares on expiration date, if you want to do this well properly, right? So if it's, say, a stock with a $10 share price, that means you must have at least $1,000 in your brokerage account sitting there, waiting to buy those stocks for when you get assigned. So don't forget that, all right? Otherwise, you end up on margin in a leverage position or something like that. Okay, but that's basically step 2. Step 3 is to start to sell a call contract against those shares. And so once you get assigned, you then swap into, instead of selling put contracts. By the way, I should have mentioned when you are selling the put contracts, you might go a 30-day period and it doesn't hit the strike price. So what do you do there? Well, then you sell another put contract 30 days out, then another one and another one. You might go 5 rounds just collecting premiums from selling put contracts, which is cool. That's the goal before you actually get assigned, okay? So there's no limit between the amount of rounds. It's just however long you just keep that wheel going. And this is then, you then move to own phase 2 and phase 3, owning once assigned. You can imagine in a bull market, you might go a year without getting assigned. I've picked 30 days because it's a round number. You can match it up to a month. 1 year is 12 lots of premiums. 12 lots of premiums of selling put contracts. That's sweet. And then after 12 months, after 12 rounds, you get assigned the shares. When you get assigned the shares, let's not panic, because that now offers you the chance to start the next phase, which is called a covered call, and that is then selling call contracts instead of put contracts. But when you're selling call contracts, you have to cover the position. You don't have to, you can sell it naked, but that's dangerous. You cover the position by owning 100 shares of the underlying. Read up on this one, it's quite important as to why we are covered. But basically, you can think about this as very similar to selling the put contracts that we were, but instead we're selling calls. Now, the reason why we have to own the 100 shares to begin with is if we do get assigned, we can then use those shares to hedge our position, to cover us. So our max, well, you're actually not going to lose if the price goes up, that's what we want. But you're capped off at the strike price. Because look at this graph here, that would be the strike price. So if you didn't have 100 shares, right, and you sold this call contract, you received the premium for selling the call contract, this line would continue to go up and up and up and up and up because you're unhedged, and technically you're open to infinite losses, potentially infinite losses. Because you own 100 shares, whatever the share price is past that point, you can cover it by selling your 100 shares, if that makes sense, right? So what happens is, above this vertical axis is profit, and then your profit gets capped at this point, because after this point, if the share price continues to go up, you have to cover with the shares that you purchased at the strike price, that you sold at the strike price, because you have to sell, you're forced to sell those 100 shares to the contract holder at expiration at the agreed upon strike price if it's above the strike price. A little bit confusing, but please read this section. So you basically just roll straight into selling calls, and when you sell the calls, I should have a little summary. Yeah, so you're going to repeatedly sell 30 delta, 30 to 45 days to expiration, call contracts against the 100 shares you own until you get called away. So called away is similar to just getting assigned with the cash secured put, but the shares that you owned, they will automatically get sold. All right. So you can start to piece together the cycle now. Sell put, sell put, sell put, get assigned. If you get assigned, sell call, sell call, sell call. If you get assigned, shares get sold, you're back even. You don't own anything, you're not selling contracts, flat. That's one revelation of the entire wheel. Again, read. And to quote True Detective, you'll do this again, time is a flat circle, because you will, once you reach the position where your shares have been called away, and that option is triggered, shares get called away, you're left even, you're left square with your brokerage platform, you repeat the cycle again. You go right back in to selling put contracts. And I'm just going to say this endlessly because it's the only way for it to make sense. Sell put, sell put, sell put, get assigned shares, sell calls against those shares, sell call, sell call, sell call, shares get called away, flat, back to sell put, sell put, sell put, and you just go around and around and around and around. The goal here is premium collection. And the most beautiful part about this is there's a lot of strategies what that people do. Like there's you might not know what this is, but there's strategies called like credit spreads and things like that, right? And iron condors, where it involves selling a put and buying a put, or vice versa at the same time. The problem is when you're selling and buying, when IV's high, you might think, oh, IV's high, let's do a credit spread, right? But you kind of cancel out your main goal because you're trying to sell and collect high premium. But then at the same time, you're also buying at high premium. So you're just fully cancelling out the advantage you had at selling at higher premium levels or high IV levels. But with this, you're owning a net seller of contracts. They're holding cash in your brokerage account and then holding shares in your brokerage account. This may be obvious, but there's no implied volatility in those two assets. There's not. They are there as a hedge to protect you from losses, right? Losses that you can't cover. But they don't come with, like if you were trying to hedge by then buying a further out the money option, you're still having to buy that option at whatever elevated IV levels there is. So you cancel out, you kind of cancel, and this is my problem with multi-leg strategies, you kind of cancel whatever advantage an option gave you. Because in option contracts, the seller always has an advantage. And the reason is options are generally overpriced. Generally, the seller will come out on top. The reason they're overpriced is very well studied. There's a ton of papers in it. Again, this is an excellent book that actually breaks down a lot of those papers. But knowing that, it's like a known, very well researched fact. It's like as known as we know on average the market average return is 8% a year, right? The S&P 500 over the course of 100 years. This is a fact like that. This fact is given to you, and it's something that it's an edge. It's an edge you can take advantage of. The wheel is a way that you can take advantage of that known edge that options are generally overpriced without leaving yourself exposed to theoretically infinite losses. Because if we didn't hedge and we just sold contracts naked, so naked is an unhedged contract position, you would be taking advantage of the fact that options are generally overpriced, and it may work. But one day, if you're naked a call position and you wake up and there's a huge announcement and the stock has gone up by 50%, a lot of people go bankrupt doing that. And I think if you're getting into option trading strategies, this is probably where you want to start by making money by selling options, because you hedge and it's relatively safe because of that fact. You hedged on the covered call position. The cash secured put, it's kind of tricky to say that that's a hedge, but you do have the cash in the account, and if the stock you already wanted to own, that's somewhat of a hedge. Okay, so let's go over the risk, because I've kind of been selling it at the moment and it sounds almost too good to be true, but there is a risk. So what's the catch? So we've got like 5 different scenarios, and the scenarios have got up big, up small, flat, down small, down big. Up big, you're going to profit. Now if it goes up big, if you picked a stock and they went up by 100%, you still profit, that's awesome. But your profit is always capped when you're doing a wheel strategy. If it went up by 50% and you're in the piece of the wheel where you're selling that put contract, you would just keep 100% of the premium given, which is good. That's our goal. That's what we wanted. Now, if it was the covered call side, you would make money from the capital gains of, because you remember you own 100 shares, and those shares move up to the strike price. So that's appreciation. That's capital gains there. And when you get called away, you're forced to sell those 100 shares at the strike. So you get the capital gains from the increased share price. Also, you get the money received from selling that call contract as well. So you kind of get 2 revenue streams on the covered call side, potentially 2, and 1 from the selling the put contract side. But because I said you have a strike price on the call side and the stock goes up by 50%, it's a capped profit return. So up big is a profit. It is achieved. It is an achievement. But it is also, think about it, it's a loss in potential returns. Like, always compare yourself with being long stock. If you were long stock, you would have been able to participate in the full 50% run up of the stock. Here, you might only participate in the 10% run up. So it's what we call like a missed opportunity. But I don't think you should stress about that. You still achieved your goal, didn't you? And it's still a better position than owning none of the stock. Up small's profit. Honestly, up small's probably the best case scenario, but it's still profit. Flat, you'll profit. Down small, you even profit. Because if it drops by 5% and our put contract is 10% out the money, you're still going to profit. Even on the covered call side, let's say that the time you put the covered call on, the share price is at $100. You own 100 shares worth of that, right? You sell a put at 110, you received $50 premium. The stock drops to 95. I'm not going to do the maths right now, but perhaps that premium you received is enough to blanket as much as a 5% loss in share price, and you still may turn a profit. So even on the covered call side and the share price goes down slightly, you can still profit. A big loss in share price is where you'll lose money. So this is quite similar to a long stock position, and that's how I think you should think about trading the wheel in terms of risk. Risk is similar to a long stock position, meaning if I own long stock and if that stock goes down, I could potentially lose money if it goes down and stays down, all right? Now, you are actually in a slightly better position than just being long stock when we're talking about risk. Because if you weren't selling premium against that stock or naked puts, if you weren't wheeling it, you won't be receiving that premium. That premium does accumulate. And so you can think about that premium as offsetting losses. I've done a quick bit of maths on a stock called Snapchat. Everyone knows Snapchat. So let's say I wanted to wheel 2 contracts. At its current premium level, I think for a 30 delta, 33 DTE for 2 contracts is paying me about $140. I worked out that would take 12 revelations, 12 wheel cycles, or to sell that amount of contracts 12 times every 30 days. I'll sell another one, right? I would have generated as enough money to cover the total risk of just owning long stock that amount of shares. Meaning if I owned 200 shares of Snapchat, I think that position would be, let's just say $1,600. I would have done enough cycles that I would have made more than $1,600. So if Snapchat went to 0 tomorrow after I've completed 12 revelations, technically I have 0 risk. It's now, from that day forward, it's a risk-free trade because I've collected more premium than the total risk of being long stock, if that makes any sense. So you can see why the continuing to do this wheel, generating the premium comes in every month as kind of like a passive income, will start to offset potential losses of being long stock. A couple of simplifications there, but you get what I mean. Okay, very important is finding suitable underlying stocks to wheel. You want a bullish outlet on the stock. Honestly, bullish, slightly bullish, or sideways is fine too. Or extremely bullish, honestly, don't really matter too much. You just don't want to do some research and you think, fuck me, this stock is really volatile, and well, volatility is not the problem. More of a bankruptcy risk, like, oh, this stock could go to 0. It's a dog shit stock, like Snapchat, which I'm going to start wheeling. Too bullish is, I would say, if you do a lot of research into a stock and you're so fucking bullish on the stock, you really think this is a 10xer, don't wheel it. That's just dumb. Just own the stock. But if it's a big blue chip established stock which might do well, that you know it's not going to double overnight, think Apple. Apple is not going to, you're not going to wake up tomorrow and Apple's double its share price. It's ridiculous. It's, I think, what is it, a 3 trillion market cap? So you're going to wake up and think it's going to be a 6 million market cap tomorrow. That's not going to happen. So right away I've given you an idea. Apple, flat to slightly bullish. You're not going to wake up tomorrow and it's not going to be 10x its market cap. That's probably a good example. These big blue chip stocks are probably prime wheeling candidates. AMD is probably a good one because I think AMD is going to be around. It has a bit of volatility, so it's going to have higher IV, which means you're going to get paid more for option premium. I think AMD has a good case to be bullish or sideways. So I think AMD is a good player. And these are, I'm just throwing some examples out there. So you want strong established companies, blue chip names. You want to avoid bankruptcy risk. Like wheeling, GameStop, yes, you got high IVs, you're going to get good premiums, but there is, I don't know GameStop too well, but there's probably a bankruptcy risk there. So you just want to keep that in mind. I'm not saying don't wheel sketchy meme stocks, but there is always that bankruptcy risk floating, which would not be good. And you want good option liquidity. I like to filter things for more than 50,000 options traded daily. I like a lot of liquidity to get in and out. The good thing about wheeling is you basically just want in. You don't have to worry about an exit because remember, we're just waiting for assignment. We're going to keep this simple. Some people wheel and they like if they're selling a put, they might exit once they've received 50% of the option premium. Let's just keep it systematic. Let's just keep it, we just wheel, we receive 100% of the premium. We wait till expiration. If we get assigned this, we get assigned. If we don't, we don't. Okay, so the problem is, I just said good companies, but the problem is the cash required to get good companies, because generally good companies have really high share prices. Remember, you need enough money to own 100 of the underlying stock. So if it's a stock price of $10, you need to have $1,000 in your bank account. If it's a stock price of $100, you need to have $10,000 in your, not bank account, brokerage account. Now, most of these really good companies, like ones that I would enjoy wheeling, I would love to wheel AMD. For example, AMD is a 164 share price. I need $16,400 in my brokerage account. If you've been following this channel for a while, the brokerage account slash slush fund that I am trading with and showing live displays of doesn't have that money in it. So for my demonstration, I have to find stocks, sketchy stocks that I can wheel that are within the budget of my slush fund that's linked to this channel and everything like that. Yeah. For you guys, I've provided a screenshot. It's an option screen I use called Option Samurai. Love it. I've simply done a screen here of all companies listed on the United States Stock Exchange that have optionality, that you can trade options on, that have options of over, I think I've gone more than 50,000 options a day traded, which is a good amount of option juice. Heaps of options here ready to trade. If you're looking at this, ignore the strike, ignore the expiration date. Take note of the ID rank if you want, but you're going to see that on your brokerage platform. This is just a list, and I filtered it from the cheapest company to the most expensive. So if adding in those inputs, there's not much. There was just this one page and some more down here. What else did I add in the filter actually? Yeah, so it was just the optionality. Yeah, so you can see the cheapest one I could find that fits that simple criteria was actually owning Ford Motors. And Ford Motors IV is painstakingly low. I looked at their options and you're making sweet fuck all, but could be safe. Ford's slightly, oh, that's another thing I've put in the filter, almost forgot. On the left, I filtered by stock score. So this is an arbitrary score. You've got a score for fundamental, a score for technical, and a score for, can't remember what the other score is, and growth. So I just made it filter for scores that were above 7 in each category. So what you're looking at is specifically stocks that generally have a bullish outlook, okay? Forgot about that one. Because I think, yeah, why isn't Snapchat in here? And the reason why Snapchat isn't here, because it has very poor scores on all three of those. So that's what I've filtered in. So in saying that, please do your own research, but you probably can't go wrong with wheeling any of these stocks that are in here. These are good companies. We've got Warner Brothers, JD Sports, Costco, Walmart, Walt Disney, ExxonMobil, and what have you. But don't take me for it, honestly. I recommend just like finding a stock you really want to own anyway. And even better if you can find one that has generally elevated IVs, like Tesla, AMD, Nvidia. These are all generally high implied volatility stocks. You're going to get more option premium, but IV does come with added risk as well. So it's about finding that balance. Yeah, but Barrick Gold's in here. Gold's kicking off lately, so there's options, right? But have a look through. This was just like to demonstrate, but wheeling any of these is probably fine. I think you'll find out you'll be okay. Pick stocks that you love, whatever, and it doesn't even have to be none of these. But just remember, you want optionality, meaning that the stock does have options to begin with. You want really, really good option volume, so you can get tight bid-ask spreads. And you can see option volume on the right. Ford has 130,000. They'll have decent option volume. JD, 77,000. I don't know what's happening there. Is that just JD Sports or is it something else? I don't know. Yeah, good option volume is what you're after. Please read through that. All right, here's the catch. After saying all that, make sure you wheel good companies, blah, blah, blah. I'm going to be wheeling one of the shittest companies out there called Snapchat. The reason why I'm bagging on Snapchat, they haven't turned a profit in God knows how long. The financial balance sheet is a fucking war zone. It's not a stock I want to own. But I'm going against the advice I'm giving everyone. Snapchat's paying good IVs at the moment. I think there's an earnings coming up. And it's just a volatile stock. And I think this would be a fun thing for me to do. And it's cheap, by the way. What are we at? $8.50 for Snapchat. So you can wheel this one contract, $850 in your brokerage account. You can start wheeling Snapchat today, paying good premiums. But Snapchat has a lot of risk. And you know what? It probably even has a bankruptcy risk. Don't know. I doubt it, but I don't know. But that said, Snapchat does have around 500 million daily users. Don't think it's going anywhere anytime soon. But yeah, it's quite funny to me to give you all this sound advice. Then I start wheeling a piece of shit company like Snapchat. But my reason for doing this is it's going to be because I'm going to do a lot of follow-up videos, and I'm going to step by step go through me actually live doing this wheel strategy for you, tracking the wheel strategy and everything like that. I'm going to post a video tonight on market open and actually get my first position on the wheel strategy with Snapchat, and I'll record it all and upload it either tonight or tomorrow morning. I've uploaded a wheel logbook. Now you're going to need to track whether your strategies are making money. Yeah, your brokerage platform tracks how each individual trade's going, but the wheel is a concoction of several trades over time. So I've created a really basic Excel spreadsheet. So if you click this button, it'll download it and you can have it for free. It's simple, right? I might build on this and make it better because I'm going to use it as well. And I think a better idea is to put in this spreadsheet. I'll add it to it and I'll update it. But yeah, so just each trade. So you're going to obviously do short puts to begin with. You might do a few rounds of short puts depending on how you go. And when you get assigned, you swap over to short call. Now your brokerage platform will show you your returns for each trade, all right? So don't need to go too advanced here. And this section here is only for the covered call section because you're also going to make gains, capital gains from owning the stock when you do the covered call part of the trade, plus the premium. So that will automatically sum those two cells. But obviously this cell is blank when we're just selling puts. And down here we have starting capital. So for starting capital, when you first put on your trade, which would be the first short put trade, if you look at max risk, bang, chuck that in as your starting capital or an approximation, right? You might decide to allocate $1,500 to a wheel strategy. So just say that 1,500 is your starting capital, right? And the reason is it's kind of hard to track because you have several individual trades mounting as one. So right off the bat, I'm just using those two contracts for Snapchat as an example, but I'll put this in properly tonight when I actually get the trade on. But at the moment, showing $140 for those two contracts in premium. So bang, total returns is $140. If this contract expires worthless, I will keep that $140. I'll roll into another short put contract. But as you can see at the moment, just that one contract is giving me a 9% return on starting capital. Remember the average market return is 8% a year. So not bad going, and this is a 30 DTE. So in 30 days, I've got 9% of the capital that's at risk, or the starting capital. Now, that's cool and exciting, but let's hold our tongue. We want to get a few revelations into the wheel in, and we'll start to get an average of our returns, all right? And each sheet, just save one sheet for one stock you're wheeling, just to make it simple. So this is owning for Snapchat. Obviously, you know how to work Excel, make a copy, change the name to whatever stock you're doing, but I've just put Snap in here as an example. This isn't accurate. This is just an example for you guys to use. Yeah, so there's that. Okay, let's reiterate a few things. So step one, find a viable stock to wheel and sell a 30 delta DTE, 30 delta 30 to 45 DTE put contracts. Go to Snapchat, sell put, Actually, let me do this tonight. I'll do a live run through. We'll go over this. We'll go over me actually doing live trading and getting the position. It'll make a lot more sense, all right? Let's just finish this DD. Step 1, find a stock to wheel, sell a 30 delta 45 DTE put contract. Step 2, continue selling put contracts until you get assigned. Step 3, once assigned, you'll hold 100 shares per contract of the underlying. Step 4, sell a 30 delta 45 DTE call contract against your shares. Step 5, once called away, return to step 1 and repeat the cycle. So you just continue to wheel around and around again. Where people go wrong is they honestly don't stand by the rules that they set. The reason why I've said 30 and 45, I mean, these aren't necessarily magic numbers. It's just that in our brains we have a systematic process. Because this is a systematic trading strategy, we've got to stick by the rules. I don't give a shit if you decide to go 40 delta, 25 delta, or whatever. Or if you go 45 DTE or 20 DTE, don't give a shit. But if you set your rules, stick by them. Now, the good thing about tracking this is you might get 10 trades in and you'll start to see which DTE, which delta, which IV is giving you the best luck, is giving you the best returns, all right? And you'll start to figure out yourself and really learn just by logging and tracking your trades what's the best setup for your strategy. And you know what? The best setup might be slightly different on different stocks. So I'm just giving you probably the more sound advice and also well researched and just going for a 30 delta 45 DTE. Sorry, 30 to 45 DTE. And just go from there. And if you're a little bit nervous and if you're not too, sure, honestly stick with those numbers. They're good numbers. You'll be fine. Read through it. I'm only summarizing things today, so. And yeah, that's basically it. Final thoughts. I like the strategy. I think we'll leave it there. And if you're really interested in this, there's a lot of good stuff I've put in here, a lot of learning about options as well. I really want you guys to, have a decent understanding before doing this trade. So that's that due diligence over. Today is the morning of the 6th of October. So tonight, live, well, I'll record it. It might not be live. I'm going to record myself going into my large brokerage platform, explaining what I'm doing, finding the delta I'm trying to look for, and actually putting on this first trade. And then I'll give updates when significant things happen. When I get called away, if the option expires worthless, which is also good, I'll give updates. And I'm going to use Snapchat as an example. You do not have to follow my suit with Snapchat because this is quite a sketchy, volatile company. But I'm going to use this as an example because I think it's going to be a good ride. And really good because we've got an earnings coming up, so that's going to be exciting too. So I'm going to wheel each step. So if you're still not too confident, but you want to start wheeling, hang tight a second. Follow me. I'm going to go in first. You can apply the same thing to whatever stock you want to wheel. But stay tuned for tonight's episode where I will put the first trade in of our wheel. And I'm going to record all the process as we get on as well. I will give you updates. I'm going to track the process down here. Progress. Once it decides to load on me. So down here, wheel began on this date. How many wheel cycles am I in? So one full revelation will be sold put, get assigned, start selling calls against those contracts, get called away. That's one revelation. So I'm going to let you know how many revelations I've done, or maybe I might break it down into covered call and cash secure put trades. We'll see. And I'll do the percentage of returns so far, which I will get off this spreadsheet down here. So right off the bat, I'm probably going to be at a 9%, but that is going to change depending on what happens to expiration. Now, you might get off to a rough start and you might be down, but remember how I said after a while, your premium returns will continue to accumulate, right? So you might be down first 3-4 trades, but if you stick at it, you probably will come out on top. as long as you haven't picked a disaster of a stock. Yeah, and you know what? So what did I say? Snap one contract. I needed about $800 in my account to wheel one contract. If I'm getting 140 a pop, a mathematician using a calculator. Don't see that every day. 5.71. It'll take, assuming I get 140 each time I sell these two contracts. If I do it 5.7 times, let's just round up to 6. And if I get 140 each time, I can add a third contract into the wheel. Because now I've gained $800 in profit from collecting insurance premiums, which is enough for me to add an extra contract into the wheel. Now I'm wheeling 3 contracts. And then in a reduced amount of time, because I'm now wheeling more, which will bring my premium up to $210, because if 2 contracts is going to be 140, 3 contracts are going to be 210. So within less amount of time, so remember 5.7, let's do 800 divided by 210. It's only going to take me 3.8 cycles or contracts sold, or 30 DTE times 3.8 times basically, to then be able to afford another contract. Now I'm wheeling 4 contracts. Now it's only going to take me 2 revelations to then add on a 5th contract. Do you see how this can culminate? But you can get like exponential returns slowly, and slowly you can accumulate and build more contracts. Yeah, we'll leave it at that. I love the wheel strategy. I can't wait to throw it in my portfolio. Oh, before I finish, final note is it sounds too good to be true. So what I don't want you guys to do is just to owning wheel. I don't want you to put your entire portfolio into wheeling. I think there's a space for a wheel strategy inside a portfolio of some other strategies, and those strategies just could be holding stock. The reason is, remember, capped upside. You don't want to get left behind by the market. So I think if you throw in some other stocks that you want to own anyway, and then you allocate a certain amount of capital to wheeling, amazing. I think that's fucking excellent. Now you're thinking about a true portfolio manager. You're thinking about, you're actually a systematic trader as well as an investor, and the knowledge you're going to learn about learning options is irreplaceable. Okay, we'll leave it at that. Thank you very much for watching. This one did drag out a bit, but I really wanted to kind of break it down a bit more. Please read the report. If you're new to options, please give it a read. Follow my progress. I'm going to start wheeling as of tonight, and we're going to track everything. If you're not sure what to do even after reading this, if you watch my updates, you'll eventually get it, because we're going to do some live wheeling on a live trading account. All right, thanks for watching. Appreciate your support.